Welcome to this video tutorial on the FinanceStarter F5Y, or Forward 5-Year, online corporate finance program. I'm Chris Wutsky with Parametric Finance, and I'm about to show you the powerful features of FinanceStarter F5Y in assessing the financing capacity and conducting a financing where a financial forecast has been prepared that sets out the expected financial results for at least 5 years following the financing transaction. The Finance Tester and the FinanceStarter T12M require only the recent annual financial statements of the company to be financed. However, the FinanceStarter F5Y, which uses a forward 5-year forecast, is better suited to financing scenarios where historical financial statements are not a good basis for projecting the future, such as a major expansion by way of asset purchase or a business acquisition. The quick guide to the Finance Tester F5Y provides detailed information on how to get the most out of the Finance Tester. The process begins with a financial forecast which provides 5 years of financial income statements and balance sheets, which you'll see here at the top and the bottom of the Excel spreadsheet on the left-hand side of the screen. The scenario we're modeling is one in which a major capacity expansion is being planned that will increase revenues, accounts receivable, cost of sales, and accounts payable by 30%, which we can see up here and here, inventory to a lesser amount, and accounts payable. Following the expansion, there will be more conservative growth rates, which we're going to see here, 4% for revenue, 3% for cost of sales, and so on down. And these will apply for years 2 to 5. Okay, so what we want to do next is go to the Resources tab of the website, right here, which you'll see on the right-hand side of your screen, and scroll down past the videos, past the guides, to the Templates and Sample section, where you'll find the FinanceStarter F5Y template. Just click on that. You'll see it'll download at the lower left if you're using Chrome. Just double click on that to open. Minimize your browser so you can get that out of the way. And then you'll see the blank template here to enter the amounts from the homemade forecast. Okay, and then we just simply start entering numbers from the homemade forecast over here into the input panel. And if we have them both open in the same instance of Excel as is the case here, we can simply start tying the numbers across with formulas. So if you watch along with me as I do some of these, we'll want to adjust some of the things that Excel likes to do here. And expenses have to come across as negatives. So all we have to do is basically populate things just like that. Fairly straightforward. Have to be mindful of the fact that we're more condensed on the input panel side than we are on the company's forecast. So that means that the row references will need to be changed. So just follow along with me as we fill this all in. Okay, now that everything is entered, and as you can see, reconciles between the company's forecast and the input panel template for the forward 5-year version of the Finance Starter, then the next step is actually to get this information into the online version. Okay, so for that, we just simply can move, make some space so we can work and grab that. So we come back to the website. We don't need to be in the resources page. We need to be up on this page where the input panel is found. So we just can scroll down and where the input panel will appear, and this is where we want to work. So just make ourselves some space so we can see everything. Okay, so this is where all the action happens. So we just simply need to work across here and enter the numbers. Unfortunately, we cannot copy paste those in the current version of what's found online. So we basically have to go along here and enter everything. But you can see that that works pretty quickly. And again, I'll let you follow along with me at a higher rate of speed, because I mean this can be done on your own and save you a ton of mind. So just bear with me here while we pick it up. Okay, so now that we have everything entered over here and in agreement with what we have on the input panel template, we're ready to take the next step. Now, the model, the online program won't do anything until we have certain key information entered up above. When that's entered, the program, the algorithm, and the database search will be functional, and we can see what are the preliminary results being generated from the information that we've entered. So let's go up here. The name and the business description is not essential at this stage, but it will be if you want to order a report. So let's go down to some of the important things like the business industry sectors in which this business operates. We're just going to select some of these just to see where we've got to. Let's say it's Alberta. It's a mature company. Now we know this is an expansion by way of operating assets. Our numbers are in thousands. Call it Canadian, and we want to select a year-end date. So now we just want to expand this and see what we've got. All right, and so we can see everything here. We've got the model, we've got the inputs, our finance panel, our override panels down below, but we're not needing that at the moment. But what we can see is that the financing strategy that has come up for the purchase of operating assets is one in which all the capital that's being raised is equity. That'll be used together with surplus cash to purchase operating assets of $59 million. So, okay, so that's a fair amount, but what's strange is that only equity is being indicated when we know that there's a ton of cash flow, a ton of assets with collateral value. So the issue we want to ask ourselves is what is happening. And we can see that online by going down here to the calculated covenants. We can see that the working capital ratio at 1.31 is below the 1.35 here that's stated as a minimum. So for a starter, we could reduce this and see what happens. Okay, we can see that senior debt has been brought in. We then see that the working capital is still the one that is the problem is the 1.3. So what happens if we put 1.1, which would be about as aggressive as I'd want to get? So you can see a lot happens. All right, so we bring in the senior term, the cash flow loan. We can see that our advance rates on the collateral are up where we'd kind of like to see them. So right at our stated maximum for the real estate, for the equipment loan at 50%, and we have some draw under the sub-debt facilities as well. So that's great. Let's say we don't feel comfortable. Let's say we want to be more conservative with the covenants, because some lenders may come up with a more conservative covenant that we want to kind of stay in line with. Well, one of the things we can tell right now is that we're not being quite as efficient with the working capital as we probably should be, because we have a lot of cash, we have a lot of payables. In fact, we have a lot of current assets and a lot of current liabilities. And the effect of that is as those numbers go up in lockstep, the ratio actually goes down. It's just a mathematical reality. So one of the things we can do is we can apply some of this cash to the payables in advance of going to the market. So let's see what happens when we do that. Let's just say, for the sake of example, that we're going to move $4 million from cash to accounts payable. I've tested these in advance, so just to expedite things so that we can get to a discussion about the changes. Cash becomes $12,252, accounts payable becomes $49,03. And there you go. We can see that a lot has changed here. We have drawn on all the debt facilities. We can see that we've come to close to our advance rates, maximums, and our working capital ratio is again the breach point, but the fixed charge coverage ratio has been drawn into the examination, in that it's starting to near its limiter as well. One of the things to note here is the equity number of $28.3 million. This is part of the financing strategy, so that there's $60.7 million of cash available to acquire the assets for the expansion. So if we look at the equity, this is an interesting area to look at. We can see that the equity dilution required would be 62% for this amount, okay? And the IRR, if the 28.3 were to take out the entire amount of equity, it would be a 43% IRR, so well above the 30%. So we look at the 62% here, and we'd ask ourselves the question, is that something we'd be happy with, to free up this much cash to undertake an expansion? And of course, the answer lies in the estimate of the cost of the expansion in the first place. What we can see here, though, is that we can probably raise about $20 million from debt financing facilities, which together with our cash on hand of $12 million gets us about $32 million of cash to acquire operating assets. So let's say that our planned expansion is expected to cost $30 million. Well, the next step is to explore the specific financing strategy that might be employed to undertake that expansion. So what we do there is we simply go down to the financing override section. Currently it's set to use indicative, which is the program's algorithm itself to derive the maximum. But we're going to transfer some of the amounts down here, and then we're going to switch this to override and see what happens. Okay, so we want to raise about $18 million in financing facilities, ignore the equity because we don't want dilution, and get us to a cash amount of about $30 million. So let's say we want to go to the max on the real estate, we want about the max on the senior term, and the sub-debt, we want to get 18 million. So we need another little bit more. So now we have $18 million raised in financing facilities. Switch this to override, and what's been entered here immediately goes into the program itself and is modeled. So we can see that up above, that we've raised 18 million, we have 12 million in cash, which results in a $30 million worth of available funding for the expansion via operating assets. So looking at the key information here is we've, as we'd expect, we'd have close to the maximum of the advance rates because our amounts here are close to the maximums originally indicated. We have a bit of sub-debt drawn, but we still have some room because we have up to a 2.5 times limiter here. And our working capital ratio is 1.41, which is over our 1.35 here. and we're good on the other covenants. So this is a doable strategy, financing strategy for expansion that costs $30 million, as we can see. But this conclusion is based on the typical financing parameters. Now recall that we'd adjusted the working capital ratio to see the impact on the indicative financing strategy. But we should take a closer look at the financing parameters input panel on the right side. The capital market is very complex, so it helps to categorize the types of instruments. We see three main buckets: senior secured debt financing, where there's a charge on assets being financed; cash flow or subordinated debt financing, which has a subordinated security position or no security at all; and finally equity, which is typically preferred or common shares without terms for repayment. Each of these is provided upon terms that constitute constraints on the financing capacity of the business. These terms can also be seen as three buckets: collateral loan value, financial covenants, and cost of capital. So now looking down the financing parameters panel, you'll first see the senior secured debt financing, revolving credit lines, capital leases, term debt on equipment, and then term debt on real estate. Then you'll see the cash flow based or subordinated debt, and finally equity. For each of these, there will be a combination of limiters and cost of capital. For debt facilities, the limiters are typically a percentage of the collateral value, whereas for cash flow or subordinated debt facilities, they're limited to some sort of cash flow-based multiple. Cost of capital is represented by the repayment obligations computed based on interest rate, term and repayment method, such as principal plus interest, blended payment, or interest only. The entire capital structure is constrained by financial covenants, shown here, that lenders typically impose. We've boiled them down to three key ones that, if you can satisfy these, there's a good chance that any others should be in compliance too. Now we've developed a financing strategy for a $30 million asset purchase, starting with the typical, relatively conservative financing parameters. And we found that using those parameters, we could debt finance a $30 million expansion, so using no equity, no dilutive equity. So let's say we wanted that expansion was going to cost $35 million and we still didn't want to use equity. Using the standard financing parameters, you just couldn't get there. But if you can try and find or negotiate better terms, find less confining lenders, or negotiate better terms, there might be a way to get to those 35 million. So let's explore one of those possibilities very quickly. Now I've tested this offline to expedite this video tutorial, but let me just lead you through some changes that can be made very quickly to basically add $5 million to your debt financing capacity. So the first thing we want to do is we want to change the override to indicative. So we go back to the default program, and we can see some of the defaults here. And note that these working capital ratio and fixed charge coverage were kind of the confining ones, as well as the advance rates. So what we want to do is we want to focus on aspects of the financing parameters that drive those constraints. And so what we want to do is we want to focus on loan value expansion and term or amortization extension. So what I've done is, let's just go through quickly here. It's not that difficult to get the advance rate on equipment from 50% to 60%. We can also often expand the loan to value rate on real estate a further 10% to 75%. Quite often the term can be extended to as long as 25 years. And our cash flow loan or sub-debt quite often can be interest only. So if we make those changes here, and finally, since we're leveraging our assets, if we can find an asset-based lender, quite often their working capital ratio will be 1.1. Okay. So once we come down and have a look here, we see that some things have changed here. We've increased our facilities. So let's pop down into the, like, although our total cash availability hasn't changed, we know this is still well over our 35 million. It's our financing facility composition that we want to see shifted towards the debt side. So let's just, first let's enter some numbers down here from above. Okay, so those are all our debt financing facilities rounded downward to the nearest 100. So we've got 24,000,005 plus a 12 gets us to 37 million, I believe, already. So if we shift this close to 37 million here, our working capital ratio is our limiter at 1.1, which we have set. And our advance rates are up near the revised maxims that we have set above. So you can see that with these changes, we were able to increase our financing capacity, our debt financing capacity, by almost $7 million. Quite doable. And so these things are situation dependent. Every company will have different rub points that the user of this input panel will need to explore what changes can punch out the parameters of the financing in a way that would be acceptable to the borrower. Okay, so say we like this, except we want to get ready to conduct an actual financing, but we really only want to raise 35 million. So because this allows us to go a little further than we, in terms of amount, than we actually need, we can relax on some of the covenants that might be a little bit too aggressive for the conventional lender, such as the working capital ratio. So what we can do here is let's back this off to a lower amount down here, and let's say we're going to take it off the operating loan because we want to leave some flexibility for seasonality. So we will reduce this until our 36,752 comes down, and so just bear with me while I find that amount. 35,052, 29,48 will be our number. So you can see here, this would be my preferred financing strategy, no equity required. We will raise 22.7 million plus our cash to have 35 million on hand to make the asset purchase and expand our business. So after having made these adjustments, we can see that we're on side with all our financial covenants here. 1.23 is above the 1.1. 3.08 funded debt to EBITDA is just under the 3.25 limiter. So we can see we're on side. If we're happy with this financing strategy, and this is something we'd like to take to the marketplace, the next step would be to develop marketing materials to present this financing to prospective lenders. So one thing you might want to do is order the report from Parametric Finance, which provides all the analyses, charts, and tables that are needed to for the marketing materials, and they've been developed to reflect these assumptions, these inputs, and not only that, there will be a list of prospective funders that are behind this particular chart here, showing the numbers of senior term, cash flow, and operating loan lenders that you might be interested in, because it'll save you a tremendous amount of time and fast track the process to completed financing. So as you can see, the FinanceStarter F5Y makes quick work of the financial analysis to identify achievable strategies and then obtain the accompanying financing strategies report that will confirm the assumptions, provide the detailed analysis, and the potentially interested funders. Thanks for watching. We invite you to review our other guides and video tutorials at the website, and we look forward to assisting you in your next successful financing.